Hello, everyone. Welcome back to the Investing Iguana, where we talk about all things investing in Singapore and beyond. I'm your host, Iggy, and today we're going to talk about ETF investing for beginners. What are ETFs? Why should you invest in them? And how can you get started in Singapore? These are some of the questions that we'll answer in this video, so stay tuned till the end. But before we begin, please remember to like this video, subscribe to our channel, and hit the bell icon to get notified whenever we upload new content. Also, this is not financial advice, so please do your own research before making any investment decisions. Alright, let's get started. What are ETFs? ETF stands for Exchange Traded Fund. It's a type of investment that trades like a stock on a stock exchange. But unlike a stock that represents a share of one company, an ETF represents a basket of different investments. These can include stocks, bonds, REITs, commodities, and more. By investing in an ETF, you can gain exposure to a whole market, sector, or asset class with just one purchase. For example, if you want to invest in the U.S. stock market, you can buy an ETF that tracks the S&P 500 index, which is composed of the 500 largest companies in the U.S. Or if you want to invest in gold, you can buy an ETF that tracks the price of gold bullion. What are the different types of ETFs? There are many different types of ETFs available in the market today. Some of the most common ones are index ETFs. These are ETFs that track the performance of a specific index, such as the Straits Times Index, STI, which tracks the top 30 companies on SGX, or the Hang Seng Tech Index, HSTI, which tracks the top 30 tech companies on HKEX. Sector ETFs. These are ETFs that focus on a particular industry or sector, such as technology, healthcare, or energy. Commodity ETFs. These are ETFs that track the price of a physical commodity, such as gold, silver, or oil. Bond ETFs. These are ETFs that invest in a portfolio of bonds issued by governments or corporations. REIT ETFs. These are ETFs that invest in a portfolio of real estate investment trusts, REITs, which own and operate income-generating properties. Active ETFs. These are ETFs that have a fund manager who actively selects and adjusts the holdings of the ETF, rather than passively following an index. The goal is to outperform the market or achieve a specific objective. What are the advantages of ETFs? ETFs offer many benefits for investors, such as diversification. By investing in an ETF, you can spread your risk across a large number of investments rather than putting all your eggs in one basket. This can reduce your exposure to volatility and market fluctuations. Low cost. ETFs typically have lower fees and expenses than other types of funds, such as mutual funds or unit trusts. This is because most ETFs are passively managed, meaning they don't require a fund manager to actively buy and sell securities. You also save on commissions and other transaction costs, as you only need to pay once when you buy or sell an ETF, rather than multiple times when you buy or sell individual securities. Liquidity. ETFs are traded on a stock exchange, which means you can buy and sell them anytime during market hours, just like stocks. You don't have to wait for the end of the day or the month to redeem your units, unlike some other types of funds. You also have more flexibility and control over your investment decisions, as you can use various order types and strategies, such as limit orders, stop-loss orders, or margin trading. Transparency. ETFs disclose their holdings and performance on a daily basis, which means you can easily see what you're investing in and how it's doing. You can also compare different ETFs based on their fees, returns, risks, and other factors. What are the disadvantages of ETFs? ETFs are not perfect, however. They also have some drawbacks, such as tracking error. This is the difference between the performance of an ETF and its underlying index or benchmark. Tracking error can occur due to various reasons, such as fees, expenses, rebalancing, dividends, market conditions, or human error. Some ETFs may have higher tracking errors than others, depending on how well they replicate their index or benchmark. Market risk. This is the risk that the entire market or sector that an ETF invests in will decline in value. For example, if you invest in an ETF that tracks the U.S. stock market and the U.S. experiences a recession or a crash, your investment will likely suffer as well. You can't avoid market risk by investing in ETFs, unless you diversify your portfolio with other asset classes or hedge your positions with other instruments. Currency risk. This is the risk that the exchange rate between two currencies will change unfavorably for you. For example, if you invest in an ETF that tracks the Chinese bond market and the Chinese yuan depreciates against the Singapore dollar, your investment will lose value in Singapore dollar terms. You can mitigate currency risk by investing in currency-hedged ETFs or using currency derivatives. How to invest in ETFs in Singapore? If you're interested in investing in ETFs in Singapore, here are some steps you can follow. Open a brokerage account. You need a brokerage account to buy and sell ETFs on a stock exchange. You can choose from various brokers in Singapore, such as DBS Vickers, OCBC Securities, UOB Kay Hian, CGSCIMB Securities, Phillips Securities, Poems, FSMoan.com, Saxo Markets, Tiger Brokers, or Interactive Brokers. Compare their fees, features, platforms, and customer service before you decide which one to use. Open a CDP account. You also need a Central Depository, CDP, account to hold your ETF shares in Singapore. A CDP account is a custodian account that records your ownership of securities listed on SGX. You can open a CDP account online or by mail, as long as you are at least 18 years old and have a bank account with one of the participating banks in Singapore. You only need one CDP account for all your investments on SGX. Choose your ETFs. Next, you need to decide which ETFs you want to invest in. You can choose from over 60 ETFs listed on SGX, or hundreds more listed on overseas exchanges. You can use various criteria to filter and compare ETFs, such as their fees, returns, risks, holdings, sectors, regions, asset classes, or strategies. You can also use online tools and resources, such as ETF Screener, ETF Comparison, or ETF Research Reports, to help you with your selection. Place your order. Once you have chosen your ETFs, you can place your order through your brokerage platform. You can use different order types, such as market order, limit order, stop order, or conditional order, depending on your preference and strategy. You can also specify the quantity and price of the ETF shares you want to buy or sell. You will need to pay a commission fee and other charges to your broker for each transaction. Monitor your portfolio. After you have executed your order, you can monitor your portfolio performance and track your returns and risks. You can use various tools and indicators, such as charts, graphs, ratios, or benchmarks, to analyze your portfolio. You can also adjust your portfolio allocation or rebalance your portfolio periodically, depending on your goals and risk appetite. But before you jump into ETF investing, there are some things you need to know and consider. In this video, I'm going to share with you 5 key tips when investing in ETFs in Singapore. These tips will help you avoid some common pitfalls and mistakes that many investors make when they start investing in ETFs. For example, did you know that there are different types of ETFs? Some are passive, meaning they simply replicate an index as closely as possible. Some are active, meaning they try to beat the index by using various strategies and tactics. Some are physical, meaning they actually own the underlying assets. Some are synthetic, meaning they use derivatives or swaps to mimic the performance of the index. Each type of ETF has its own advantages and disadvantages, and you need to be aware of them before investing. For instance, passive ETFs tend to have lower fees and tracking errors than active ETFs, but they also have less flexibility and potential for outperformance. Physical ETFs tend to be more transparent and secure than synthetic ETFs, but they also have higher costs and tax implications. You also need to know what index the ETF is tracking and how it is constructed and weighted. For example, some indexes are market cap weighted, meaning they give more weight to larger companies. Some are equal weighted, meaning they give the same weight to all companies. Some are factor weighted, meaning they give more weight to certain characteristics or factors, such as value, growth, or momentum. The index composition and weighting can have a significant impact on the performance and risk of the ETF. For example, a market cap weighted index may be more exposed to certain sectors or countries that dominate the market. A factor weighted index may be more volatile or cyclical depending on the market conditions. You also need to know what assets the ETF holds and how diversified they are. For example, some ETFs may hold hundreds or thousands of stocks or bonds across different countries and sectors. Some may hold only a handful of stocks or bonds from a specific niche or theme. Some may hold other types of assets, such as commodities, currencies, or real estate. The asset allocation and diversification of the ETF can affect its returns and risk profile. For example, a diversified ETF may offer more stability and lower volatility than a concentrated ETF. A thematic ETF may offer more growth potential than a broad-based ETF. A commodity ETF may offer more inflation protection than a bond ETF. Tip number 2, choose the right platform to invest. The second tip is to choose the right platform to invest in ETFs. There are 3 main ways you can invest in ETFs in Singapore: through a stock brokerage account, through a regular share savings plan, RSS, or through a robo-advisory platform. A stock brokerage account is a platform that allows you to buy and sell stocks and other securities on various exchanges around the world. You can open a brokerage account with any of the local or foreign brokers that operate in Singapore, such as DBS Vickers, OCBC Securities, UOB Kay Hian, Saxo Markets, Interactive Brokers, or Tiger Brokers. A brokerage account gives you the most flexibility and control over your ETF investments. You can choose from a wide range of ETFs listed on SGX or other overseas exchanges, such as the US, Hong Kong, or Australia. You can also decide when and how much to buy and sell, and adjust your portfolio according to your needs and preferences. However, a brokerage account also comes with some drawbacks. You need to pay commissions and fees for every trade you make, which can eat into your returns. You also need to monitor the market movements and exchange rates, which can be time-consuming and stressful. You also need to have some knowledge and skills to analyze and select the best ETFs for your goals and risk appetite. A regular share savings plan, RSS, is a platform that allows you to invest a fixed amount of money every month into a pre-selected ETF or basket of ETFs. You can sign up for an RSS plan with any of the 4 providers in Singapore: FSM1, POEMS, OCBC Blue Chip Investment Plan, or Maybank Kim Eng Monthly Investment Plan. An RSS plan gives you the benefit of dollar cost averaging, which means you buy more units when the price is low and less units when the price is high. This can help you reduce the impact of market fluctuations and lower your average cost per unit over time. An RSS plan also helps you automate your investing process and stick to a disciplined savings habit. However, an RSS plan also has some limitations. You have a limited choice of ETFs to invest in, mainly those listed on SGX or Hong Kong. You also have less flexibility to adjust your portfolio or withdraw your money, as you need to follow the monthly schedule and minimum amounts set by the provider. You also need to pay fees for every transaction, although they are usually lower than brokerage fees. A robo-advisory platform is a platform that uses algorithms and technology to create and manage a personalized portfolio of ETFs for you based on your goals, risk profile, and preferences. You can open an account with any of the robo-advisors that operate in Singapore, such as Stashaway, Saif, Endowus, AutoWealth, or MoneyOwl. A robo-advisory platform gives you the advantage of professional guidance and expertise, as the robo-advisor will select the best ETFs for you and rebalance your portfolio periodically to optimize your returns and risk. A robo-advisory platform also saves you time and hassle, as you don't need to do any research or trading yourself. You just need to set up your account, fund it, and let the robo-advisor do the rest. However, a robo-advisory platform also has some trade-offs. You need to pay an annual management fee for the service, which can vary from 0.2% to 0.8% depending on the platform and the amount invested. You also have less control over your portfolio, as you have to trust the robo-advisor's decisions and strategies. You also have less access to overseas ETFs, as most robo-advisors use US-listed ETFs for their portfolios. So which platform should you choose? Well, it depends on your personal situation, preferences, and goals. There is no one-size-fits-all answer. You can also use a combination of platforms to suit your needs. For example, you can use an RSS plan for your core portfolio of broad-based ETFs, a brokerage account for your satellite portfolio of niche or thematic ETFs, and a robo-advisory platform for your retirement or education savings. Tip number 3, diversify your portfolio. The third tip is to diversify your portfolio. Diversification means spreading your money across different types of ETFs that have different characteristics, performance, and risk profiles. This can help you reduce your overall risk and increase your chances of achieving higher returns. For example, you can diversify your portfolio by investing in ETFs that cover different asset classes, such as stocks, bonds, commodities, or real estate. Each asset class has its own advantages and disadvantages, and they tend to perform differently under different market conditions. For instance, stocks tend to offer higher returns than bonds in the long run, but they are also more volatile and risky in the short term. Bonds tend to offer lower returns than stocks in the long run, but they are also more stable and less risky in the short term. Commodities tend to offer inflation protection, but they are also subject to supply and demand fluctuations. Real estate tends to offer income generation, but they are also illiquid and costly. By investing in a mix of asset classes, you can balance out the risks and returns of each one and create a more stable and consistent portfolio. You can also diversify your portfolio by investing in ETFs that cover different geographical regions, such as Singapore, Asia, US, Europe, or emerging markets. Each region has its own economic and political factors, growth prospects, and challenges, and they tend to react differently to global events and trends. For example, Singapore is a small and open economy that is highly dependent on trade and finance. It is also a stable and well-regulated market that offers safety and quality. Asia is a large and diverse region that has many fast-growing and dynamic economies. It is also a source of innovation and opportunity. US is the world's largest and most influential economy that has many leading and dominant companies. It is also a hub of technology and entrepreneurship. Europe is a mature and developed region that has many established and reputable companies. It is also a leader in social and environmental issues. Emerging markets are countries that have high potential for growth and development. They are also a source of risk and uncertainty. You can also diversify your portfolio by investing in ETFs that cover different sectors or themes, such as technology, healthcare, consumer, energy, or ESG. Each sector or theme has its own drivers, trends, and challenges, and they tend to perform differently depending on the industry cycle and consumer demand. For example, technology is a sector that has high growth potential and innovation. It is also a sector that is constantly changing and evolving. Healthcare is a sector that has high demand and resilience. It is also a sector that is highly regulated and competitive. Consumer is a sector that has high diversity and adaptability. It is also a sector that is influenced by consumer preferences and behavior. Energy is a sector that has high impact and importance. It is also a sector that is affected by environmental and geopolitical factors. ESG is a theme that focuses on environmental, social, and governance issues. It is also a theme that is gaining more attention and popularity. By investing in a range of sectors or themes, you can benefit from the growth and innovation of each one and reduce your dependence on any single industry or trend. By investing in a variety of regions, you can capture the benefits and opportunities of each one and reduce your exposure to any single market or event. Tip number 4, be mindful of the costs. The fourth tip is to be mindful of the costs involved in investing in ETFs. While ETFs are generally low cost compared to other types of investments, they are not free. There are still some fees and expenses that you need to pay attention to and minimize as much as possible. One of the main costs of investing in ETFs is the expense ratio. The expense ratio is the annual fee charged by the ETF provider for managing the fund. It covers the administrative, operational, and marketing costs of the fund. It is usually expressed as a percentage of the fund's net asset value, NAV. The expense ratio can vary depending on the type, size, and complexity of the ETF. For example, passive ETFs tend to have lower expense ratios than active ETFs because they required less management and intervention. Large ETFs tend to have lower expense ratios than small ETFs because they can benefit from economies of scale. Simple ETFs tend to have lower expense ratios than complex ETFs because they have less costs and risks involved. The expense ratio can have a significant impact on your returns over time, especially if you are investing for the long term. For example, if you invest $10,000 in an ETF with an expense ratio of 0.3% for 10 years, assuming an annual return of 8%, you will end up with $20,518. However, if you invest in an ETF with an expense ratio of 0.6% for the same period and return, you will end up with $19,852. That's a difference of $666, or 3.2% of your final value. So how do you find out the expense ratio of an ETF? Well, you can look it up on the ETF's website or prospectus, or on platforms like dollarsandcents.sg, moneysmart.sg, or omy.sg. You can also compare the expense ratios of different ETFs that track the same or similar indexes to see which one is more cost efficient. Another cost of investing in ETFs is the brokerage commission. The brokerage commission is the fee charged by your broker for executing your buy and sell orders. It is usually expressed as a percentage of your transaction value, subject to a minimum amount. The brokerage commission can vary depending on the broker, the exchange, and the currency of the ETF. For example, local brokers tend to charge lower commissions for SGX-listed ETFs than for overseas-listed ETFs because they have lower operational and regulatory costs. Foreign brokers tend to charge lower commissions for US-listed ETFs than for SGX-listed ETFs because they have more access and liquidity in the US market. The brokerage commission can also affect your returns over time, especially if you are trading frequently or in small amounts. For example, if you buy $1,000 worth of an SGX-listed ETF with a local broker that charges 0.28% commission with a minimum of $25, you will pay $25 in commission, which is 2.5% of your transaction value. However, if you buy $10,000 worth of the same ETF with the same broker, you will pay $28 in commission, which is only 0.28% of your transaction value. So how do you find out the brokerage commission of an ETF? Well, you can check it on your broker's website or platform, or on platforms like dollarsandcents.sg, moneysmart.sg, or omy.sg. You can also compare the brokerage commissions of different brokers that offer access to the same or similar ETFs to see which one is more competitive. Tip number 5, be patient and consistent. The fifth and final tip is to be patient and consistent when investing in ETFs. Investing in ETFs is not a get-rich-quick scheme. It is a long-term strategy that requires time and discipline to work. One of the biggest mistakes that many investors make when investing in ETFs is to chase performance or follow the crowd. They may buy an ETF when it is hot or hyped up and sell it when it is cold or unpopular. They may switch from one ETF to another based on short-term results or market sentiments. They may panic when the market crashes or euphoric when the market rallies. These behaviors can lead to poor returns and high costs. They can also cause emotional stress and frustration. They can also make you miss out on the long-term benefits and opportunities of investing in ETFs. One of the best ways to avoid these mistakes is to adopt a buy-and-hold strategy when investing in ETFs. A buy-and-hold strategy means that you buy an ETF based on your goals and risk appetite and hold it for a long period of time, regardless of market fluctuations or noise. You only sell it when your goals change or your risk tolerance changes. A buy-and-hold strategy can help you achieve higher returns and lower costs over time. It can also help you reduce emotional bias and behavioral errors. It can also help you benefit from compounding interest and dividend reinvestment. Another way to enhance your buy-and-hold strategy is to use dollar-cost averaging when investing in ETFs. Dollar-cost averaging means that you invest a fixed amount of money at regular intervals into an ETF, regardless of its price or performance. You can do that by using an RSS plan or a robo-advisory platform, as mentioned earlier. Dollar-cost averaging can help you smooth out the volatility and uncertainty of the market. It can also help you avoid timing the market or making impulsive decisions. It can also help you build a habit and discipline of saving and investing regularly. So when investing in ETFs, remember to be patient and consistent. Don't expect instant results or chase after fads. Stick to your plan and goals. Invest for the long term and enjoy the journey. If you found this video helpful, please hit that like button. It really helps us to understand what kind of content you want to see more of. And don't forget to subscribe. Here at the Investing Iguana, we're dedicated to helping you navigate your financial journey with confidence and clarity. And guess what? There's plenty more where this came from. Stay tuned for our upcoming videos, where we'll tackle other interesting financial topics like the best investment strategies, understanding the stock market, and how to make your money work harder for you. As always, we're thrilled to have you as part of our Investing Iguana community. Your support helps us keep producing free content like this. Remember, every like, share, and subscribe goes a long way. Thanks for joining us today. Keep investing, keep growing, and we'll see you in the next video. Bye for now.